There's no revenue. No one wants to see revenue. Go.
I just thought that mainly the goal of companies is to make money.
Yeah, no. That's not how it works.
Hi guys, welcome back to the channel. My name is Dave, and first of all, happy birthday, Mom. And second of all, today I want to talk to all the long-term investors out there, the people that like to buy and hold stocks forever. Because I'd like to put myself in this category, but I know on this channel I do talk a lot about options, enhancements to our portfolio. But in general, when you talk about, oh, where did I grow my wealth? It was from buying and holding stocks for the long term, based upon these two principles. And I'll show you some real-world examples. So, if that is what you're looking for, please stick around. Whoop.
I've never had pains like this before. Oh, this is the worst one I ever had, son. Oh, it's the worst one. This is a big one. I'm dying.
And it could be the big one, but whether you're Fred Sanford or Ray Dalio, there's definitely some tough economic headwinds that we're heading into right now. So we'll see where we end up landing, but I don't believe it's the end of the line. So I'm a long-term investor at heart. Last week, somebody was asking me about Intel and why I'm buying Intel with a little upside. I do believe it has very little upside right now, but I believe it's a great company going forward 5 or 10 years. And as a long-term investor, I feel pretty good about that. So that brings me to principle number 1, and it's short and sweet. It's basically saying, if you're a long-term investor, forget about the green and red in your portfolio. You have to learn to ignore it. You can't buy a stock and care whether it's red or green week 1, week 2, or week 3, or maybe even year 1 or year 2. Earlier this year, Warren Buffett added Citigroup to his portfolio. Do you think that's up or down, red or green right now? It's red, right? Warren is down for sure in Citigroup right now. What a horrible billionaire investor he is. But the principle here is he doesn't invest in junk. You typically won't see him buying something that, like a struggling business. It doesn't matter how cheap a bad business gets, he's not buying it. You know, one of the best Warren Buffett quotes is, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So if you are a long-term investor, and you should be picking great stocks and ETFs that you believe will be of greater value in the future, long-term, not in 2 weeks, not after bad CPI data on a Friday, not when your portfolio is red or green. Now, I don't want to put words in anybody's mouth, like when I'm talking about Warren Buffett especially, but you know, with his addition to Citigroup as a long-term hold, which I assume is what it is, you know, he didn't do it because it fell to $50 a share, and he won't sell it if it turns green or red this year. But I think about it for his long-term view. You know, just like I bought Intel with a long-term view. It's cherry red in my portfolio right now, but that's not a reason for me to sell it as a long-term investor. And here's another example within my own account, Boeing and Bristol Myers. These are two stocks that I like, recent investments that I've made within the last 2 years. Now, Boeing is on fire in a bad way, right? Lots of issues, but I believe they've got a great moat, and I think they're going to turn this around. And in the long term, it will be a good investment for me. Whereas when I look at Bristol Myers, I think, wow, it's holding up really well because of pricing power, right? It really doesn't really care too much about bad CPI data because they're probably going to just pass these price increases along. So I got one in red and one in green, but I believe I've got two great long-term investments here. So, you know, I get asked a lot about my investments after a few months, and I think everybody's kind of missing the point here, right? I'm not concerned about the current color or emotional situation that we're in because of the second reason we're going to talk about. But before we talk about principle number 2 exactly, let's talk about an investment that I started making in Procter & Gamble. Let's look at a year-to-date chart. This chart, year-to-date, 2022, doesn't look great, right? Started out about $160 a share, it's down to about $140. So it's had a poor 2022. But I've been buying this for years. So most recently, my last purchases were in 2018 and 2020. And if we look at those, I've had a nice return. Nothing outstanding, nothing amazing. Nice return, though, over that time, even with the poor performance so far in 2020. So we're looking at returns of anywhere from about 20% to about 78%. Pretty nice. But that wasn't the first time I bought Procter & Gamble. I've been buying it for years. I've used Crest toothpaste all my life, right? And just like Bristol Myers, they have pricing power. So in this type of market, they're pretty well off. They do pretty well. You know, but you know, if you look back at some of my older purchases, way back here on page 4, right? I first purchased Procter & Gamble just prior to the Great Recession, back around 2008. This is the financial crisis that we're talking about, right? I made that first purchase in May 2008. You can see right here, just over 14 years ago. And I added some more shares about a month later after the stock dropped about 5%. It would have been red, down 5%. Now, Financial crisis hit, and I added some more shares about a year later as the stock started to come back just a little bit. But if I looked at my portfolio that time, it would have said I'm down about 25% from my first purchase. It would have looked like that Boeing trade. Horrible. What does it look like now? Let's take a look at the chart. Where are we now? And that brings me to principle number 2, which is buy great stocks and ETFs. I know. Pretty scientific. But what I'm talking about here is stocks that make money, not stocks that promise to make money in the future.
You're a potential pure play. It's not about how much you earn. It's about what you're worth. And who's worth the most? Companies that lose money.
Love that show, by the way. I'm still working on my car with doors like this versus like this, but it's coming along. But what I'm really talking about here is mature companies. Positive cash flow. It doesn't have to be sexy. It just has to be effective. You don't have to be there. You have to be the early adopter of some new kind of technology in order to have success in the stock market. And here is another example, this time with Apple. This one's truly impressive. I look at this one, love it every time. Now, you did not have to be in Apple at the very beginning to have success. My 2018 purchase right here still looks pretty good, right? Even after recent declines, I've got 130% return. And along the way, collecting some nice dividends as well. But we're not interested in recent history. We want to go way back because we're long-term investors again. So let's go back to that great recession, that financial crisis that was so horrible. Because I was the idiot that bought Apple. Can you believe it? And I watched it plunge. I bought it in 2008 in January for $6.31 per share. Ugh, horrible. Because you know what it did that month? It went all the way down to $4.50 per share. What a dummy. I mean, I lost 28%. My portfolio was splashed full of red, right? In just 1 month. But it wasn't even done, not even close. Because 1 year later, in January of 2009, it hit $2.80 per share. I was now down 56%. What a dummy. But if we look at a chart today, we know we did okay. So my investment turned out all right. And with the little bit that I put in that day, I could probably buy a Tesla. We'll take a look at that at the minute. But let's talk for a second about this $2.80 per share price that you could have bought Apple with. That was the ultimate pain point, right? That was the ultimate pain day. I'm sure plenty of people saw the red and they sold and they felt relief that day. And I'm also sure plenty of people that bought that day probably sold once it rose 10, 15, 20, 25%, right? Or maybe they doubled their money and they ran for the hills. And I'm sure plenty of people also that day that had lost 56% finally got their money back several months later and they ran for the hills at a break-even point. They were happy. They achieved their mission. They made nothing and they didn't lose anything. As for me and that initial investment that I made in January of 2008, if you go back and look at it, I put in about $2,400 and it has grown all the way up to over $52,000 at its current price, up over 2,000%. Like I said, maybe enough to go buy me a Tesla. Not too bad. Apple's performed exceptionally well. And obviously I still had a belief in Apple because they added more shares in 2013. So let's think about what happened here. We bought shares for $6.31. It dropped all the way down to where I was down 56%. Climbs all the way back up, goes flying past, more than doubles. And at that point, you sit there and you go, okay, it's still a great stock, a great company. I'm willing to put more money in at $15.45 per share. Put another $8,600. I'm going to invest that. What's going to happen? Well, again, I have a long-term belief. Turned out quite well because it's up over 787%. It's worth almost $77,000 now. So I'm not showing these numbers to impress you. I'm just doing this to impress upon you the value of these types of principles if you're going to be a long-term investor. Now, as my buddy Warren Buffett would say, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. So if you find a product that you really like, that you love, that you use every day, and you understand some of the fundamentals behind the company, feel free to go in there and buy a few shares and write it out for the long term. Now, if you don't feel comfortable with doing that, that's why we have ETFs. That's why we can dollar cost average and just kind of study some of the general market conditions of when we might buy a little bit more, a little bit less, and feel like over a period of time, the stock market is going to go up and to the right where we need it to go. And we'll feel good about our investment strategy over the long term. So as an official long-term investor, I don't really care in that first 6 months, 12 months, whether it's red or green. So don't even ask me. You can ask me. I'll always answer, but you understand my point here is that I'm buying for the long term. When I say that, it's 5 or 10 years down the road. I'm still going to watch the fundamentals as we move forward. I'll make adjustments as necessary if I really don't like it. But in general, when I make that decision to pull the trigger, it's because I like the stock going forward and I believe in the company going forward. Now, if you have any questions on any of this, please ask down below. Really appreciate you watching. Have a great night. Good luck with your investing. We'll see you soon. Bye.
ROI. You know what that stands for?
Return on
Return on investment.
Nope. Radio on Internet.